Yeah, we missed last week's lecture due to some unavoidable engagements, but we will continue what we were discussing. We were basically discussing about the central banks, and particularly we were talking about the Central Bank of the US, the Federal Reserve, and then we also started comparing most of the aspects when we were talking about Fed Reserve in line with Central Bank of Sri Lanka, the Sri Lanka's case. And also we would be discussing few other leading central banks in the process. But what we have to broadly say is, I mean, most of these central banks that you are discussing have in general similar circumstances and similar operational structures, except at certain points that we will highlight as we discuss. And I remember the point where we were discussing, we were talking about Fed Reserve's functions, and we looked at Fed acting as a liaison also between business community and the decision-making process within the central bank itself. Okay, and then the general processors in the form of they are continuing to examine the operations of financial intermediaries that come under their regulation. So that is like banks, for that matter. Banks also hold certain type of business interests, like holding companies. Okay, and then they look into those holding companies also, because they define certain type of activities allowable within the central bank purview, and other activities they don't allow. And similarly, I was mentioning in the US case, they, apart from centrally federally governed arrangement, they also have state affiliations. If state, that means the state in the case of US, where you can compare, like, let's say, provinces in Sri Lanka, but in the US case, it's a federal constitution. So they have different states. It's a combination of states that sets the United States of America. So in the case of US, they have that different states and certain type of financial intermediaries only limited to that particular state. So the state chartered, the license for that such operations being issued by the state regulatory arrangements, those agencies, those financial intermediaries also looked after, examined by the Federal Reserve. And then they do the kind of a processing of information for information symmetry purposes. You know, everywhere the problems arise from information asymmetry. Okay, so the central bank tries from all the angles to bring in so-called information symmetry. They make sure at least the minimum standards of information available for all market participants. And also they do professional engagements in the form of research economists to conduct monetary policy. And conducting monetary policy, we'll be able to see as we move on with some further details in this discussion itself. So this is where we were broadly stopped some of our discussions last time, and now you are simply moving in, and you are seeing some more engagements of the Fed Reserve system. So what you are simply seeing here is the monetary policy. Okay, so monetary policy, when I'm discussing this in this discussion, I'll try to bring in the explanation in comparison to Sri Lanka's conduct of monetary policy also. And then you can kind of, if you require further clarification, as I'm repeatedly requesting, you can send whatever questions, so we can still follow up with the discussion. So you see these details in the slide itself, but I'm trying to kind of build in the sense you see the discount rate. Okay, So why discount rate in the case of Fed Reserve is it's a single rate that they target in the case of US and most of the OECD central bank. So they call this as a policy interest rates for that matter. Okay. But in the case of Sri Lanka, you see we target a corridor. Okay. It's not a single rate as one could call it, but we have the overnight deposit rate and overnight lending rate, right? So you see in Sri Lanka's case, it is 4.5% and 5.5%. Overnight deposit rate is 4.5% and overnight lending rate is 5.5% as of now. Okay, this changes with monetary policy decisions, right? So we do the kind of cap and the ceiling, cap and the floor, cap is the ceiling, right? So we see the flow as the overnight deposit rate, where the financial intermediaries, licensed commercial banks and primary dealers, at the end of the day, if they have excess cash, excess liquidity, they can bring that and deposit with the central bank. And if they wanted to borrow on an overnight basis from central bank's open market operations window, OMO window, they can borrow at overnight lending rate, that is 5.5%. But for lending, central bank would ask these banks to keep collateral. They have to keep an underlying security to borrow from the central bank. Okay, so when it comes to operations like that in many countries, right? So you see that the market overnight interest rates, they wanted this overnight interest rates to be established between this upper ceiling and the lower floor. So the overnight lending rate and overnight deposit rate, 5.5%, 4.5%. So within this, they wanted to see overnight interest rates settling in the market. For instance, in Sri Lanka's case, central bank would very keen to see where the call money rate is. Call money rate means the interbank financial exchange rate, where banks do not keep collateral between their financing operations, but they have limits. They can't be just lending without any collateral beyond a certain amount of funds, because they also expose us to risk. But what their call money is, the banks, interbank overnight lending arrangements, where probability that they don't keep collateral, right? So this overnight rate in the market to be established between overnight deposit and overnight lending rate in the case of Sri Lanka, right? So what you are simply seeing now is, in the case of Sri Lanka, the treasury bill interest rates are also fell within this boundary. For instance, if you see 91-day, that 3 months treasury bill rate at the last primary offering was decided at 4.52%. And the 6-month interest rate was decided at 4.67%. And the 1-year interest rate, 364-day interest rate, was determined at 4.89%. So you can see all the rates are very close to the lower bound, that is 4.5% deposit rate, but very much away from upper bound overnight lending rate, that is 5.5%, even the 1-year treasury bill rates, right? So that signals many other economic aspects, so we are not getting into that. But what you are simply seeing here is, in the case of Central Bank of Sri Lanka, the Federal Reserve and the monetary policy that we are talking about, Fed Reserve here, the Central Bank of Sri Lanka and the monetary policy is concerned. The Central Bank of Sri Lanka defined not a single rate as discount rate in the case of Federal Reserve, but a corridor which comprised of overnight lending and overnight deposit. And the central bank expects market rates, overnight market lending rates, to be defined within that corridor, established within that corridor. And if central bank wanted to drive that interest rates towards a particular direction within that corridor, they would do open market operation by selling government securities or buying government securities from the market. That would drive liquidity or absorb liquidity and thereby make the interest rates to establish within that corridor. You see this. So most of the central banks in the world, mainly in emerging and frontier market economies, try to have this discount window kind of arrangement where you see the financial intermediaries can access this either through a corridor of interest rate, and they prefer market to establish between those corridors, or single interest rates, mainly among advanced financial markets, OECD countries like US, and they establish the discount rate. That's a single rate. Okay, and also the central bank, in the case of US, the Federal Reserve, decide which banks can obtain these discount loans. Generally, all the licensed commercial banks can obtain these discount loans from the discount window. But at times of financial stress, financial market difficulties, they probably expand the access to these discount loans by other financial agencies too. For instance, they might extend this to mutual funds, saving institutions, and at times even non-bank, non-financial intermediary agencies also. They have done this in 2008-9 period. Okay, in the case of Sri Lanka, who can access the discount overnight deposit and overnight lending? That is the licensed commercial banks, not licensed specialized bank. In Sri Lanka's case, there are licensed specialized banks like NSB. They can't access, right? And regional development banks, no, right? But what in Sri Lanka's case, who can access these licensed commercial bank plus primary dealers? Leasing, finance, they can't access. Okay, so the central bank decide who can access the window, right? So who can access to obtain the discount loan from the central bank is a decision the monetary policy defines in terms of its ultimate objectives, and the central bank decide. And in the case of Fed Reserve also, they decide who can access. At different times, they can expand, they can shrink based on market circumstances. Okay, and also the Fed Reserve and the monetary policy in this process, we know the composition and the setup of arrangements in US. Okay, these Fed Reserve banks, you know, 12 in the case of US, they have a board of directors, and they select these directors through the member banks. You see, commercial banks are members in the case of US case. So they select central bank, commercial banker from each district to serve one so-called Federal Advisory Council. You know, there's a Federal Advisory Council that advises the Federal Reserve Governing Board, where the chairman and other members sits in terms of decision making, and also FOMC. You probably know all that because we discussed in detail in our last discussion. So this Federal Advisory Council brings in expertise from these commercial bankers, and the commercial banker being selected into this from each district. Okay, and they kind of work in collaboration with the Board of Governors in the case of Fed Reserve, and provide information to kind of make monetary policy decision. And I was mentioning in our last discussion, in the case of Sri Lanka, we have so-called Monetary Policy Committee, MPC, and also we have Financial System Stability Committee, right? So you see Monetary Policy Committee, MPC, and Financial System Stability, FSSC, okay? You bring in because we have price stability and financial stability objectives in the case of Sri Lanka. On top of this, we have an advisory arrangement in the form of consultative committees. We have a monetary policy consultative committee. We also have a financial system stability consultative committee. right? So most of the time you find market participants, people from academia, right? And also the established names in terms of financial markets expertise. They are the members of these advisory councils, right? So they bring in the kind of information for the use of the monetary board in the case of Sri Lanka, and similarly the board of governors in the case of US. And then at the same time, okay, the Federal Reserve and the monetary policy process, you see FOMC, Federal Open Market Committee, where 12 members are there. So these 5 members, they are elected from Federal Reserve banks. Always the New York Federal Reserve president is a member of this FOMC, and other 4 coming from other 11 on a rotational basis. They also have vote in the process of decisions in the FOMC. So this is the process through which the Federal Reserve makes their policy decisions. And in the case of Sri Lanka, you see it's the monetary board. Monetary board comprised of 5 members. I was explaining to you last time. So they are the ones who make the decisions, right? They get all the inputs from Monetary Policy Committee and continuous discussion with respect to line department, and also MPCC brings in inputs, and Monetary Policy Committee takes those stuff to the board, that the Monetary Policy Consultative Committee's information. Similarly, the Financial Stability Committee and Financial Stability Consultative Committee, they bring in those inputs. Okay, so we will get into these details as we move on. Any questions that you have? Right. So you see here, so you have member banks also in this process. So in the case of US, the banks are the members, and they are the ones, they contribute for the capital of Federal Reserve banks in each districts. Okay. So all national bank, that means irrespective of whether you have you are not restricted to a particular state, you are crisscrossing the state boundaries. So that means national banks are required to be members of the Federal Reserve System. They are naturally the members in the case of Federal Reserve System. And the commercial banks, they are chartered by states. They are not necessarily required to be members, but they may choose to be members. It's a voluntary. It's not that they're required to be members, but they can become members. And then, of course, there are some deregulation acts in the case of US, right? And then they brought in the reserve requirements. Reserve requirement is nothing but a certain reserve, certain percentage of deposits with the banks being kept with the central bank. That is the reserves. The reserve requirement is the percentage that central banks define at different times. In Sri Lanka's case, it is now at 2%. Only 2 rupees of 100 rupees deposits the banks need to keep with the central bank. It was somewhere around 8% some time back. They gradually brought down in the case of Sri Lanka, and similarly in US also, I believe it is very close to 1%. I don't have precise number with me right now, but it is very low in the case of all these advanced economies. Okay, and they have brought in this reserve requirement for all the banks for same reserve percentage. They had a different percentage for different financial intermediaries in the case of US prior to 1980, but with this deregulation act that we are referring here, they have brought in a kind of a singles arrangement in the process. Okay, and also the member banks get the access to all Federal Reserve facilities, discount facility and lender of last resort facility, Lender of last resort means when everybody else in the market do not lend to the financial intermediary, your godfather is the central bank. So you go to the godfather and get the financial assistance, particular liquidity assistance at very difficult financial circumstances. But at normal times also, sometimes the banks prefer to come to the central bank rather than going to another counterpart in the market, simply because when you go and try to get finances, that counterpart get to know your financial situation. So you lose a bit of your goodwill. So you tend to look perfect with all other counterparts in the market, but your real problem, you don't show it to them, but you go to the central bank and get financial facilities on a temporary basis. And for that also they use lender of last resort facilities. But perfectly speaking, lender of last resort facilities when everything else being lost from market access, you access in central bank for financial assistance, mainly the liquidity assistance. So this is a kind of arrangement. So all the banks have access in the case of member banks when it comes to US for this type of facilities. Okay, so you know now board of governors, we were discussing about this board of governors in our last discussion also, right? You see all the central banks in US, Federal Reserve banks in US being scattered around the country, numbering to 12, but the board of governors, they are sitting in Washington DC. The 7-member board of governors, where the chairman also he is the governor from a Sri Lankan central bank per se. So chairman of the Federal Reserve and other members, they are numbering to 7. They are headquartered in Washington DC. Okay, so they've been appointed by the president of the US and confirmed by the Senate. And their term is 14-year non-renewable term. It's a long period. 14-year non-renewable term means it's a long period. But what is interesting here is they could resign before that. So that's a voluntary decision. Or sometimes with the change in administration, they probably relinquish their engagement and they go back to their previous profession. So this happens often in the case of central banks. And the 14-year renewable term is very, very important in terms of longevity. So in US case, a president's term is 4 years. One president can have 2 terms, that means 8 years. But a 14-year renewable term to a board of governors. In the case of Sri Lanka, a president and a parliament's term is 5 years, right? And a member, a monetary board member, or the governor of the central bank being usually appointed for a 6-year term. They could resign before that. That's a different call. But it's a 6-year term. There also, it's reasonably long because if your government is 5 years, you can still stay beyond a government's tenure, right? So in the case of US, it's much longer, and this longer period is also establishes the concept of central bank independence. Okay, so then the central bank could continue irrespective of what the changing governments, changes happens in political administration. They could continue because they must be not looking at things from a political per se, but they probably be looking at more a broader macro and economic perspective. Macroeconomic perspective. So this longer term is also an indication of some independence in terms of operations of central banks all around the world. So most of the central banks have this type of a long tenure for their board members. Okay, so these 7 members also required to come from different Federal Reserve districts. Not everybody coming from single district. So to say that the distributed decision making and also bringing expertise across different districts is envisaged through this arrangement in the case of US. But there is no requirement as such in the case of a small country like Sri Lanka. But in other countries, there's some check and balances in terms of different fields of expertise represented in the broader decision-making board, like Board of Governors in the case of Fed Reserve, and that makes everybody's voice being heard. And of course, one of the resistance for establishing a central bank in the case of US was that they are disliking that the diversified or decentralized powers, these decision-making powers, being centralized in the event of an establishment of a central bank. So they were mindful at the time of establishing the central bank in the case of US, Fed Reserve in the case of US, right? Still wanted to see that decentralized arrangements being continued. So they are facilitating these different members of the Board of Governors coming from different Fed Reserve districts. Okay, so chairman or the governor is chosen from the governors and serves 4-year term. Each term of a chairman is a 4-year term. He could be appointed, but at times they could be replaced before that through a lot of negotiations and discussion. But generally, a term is a 4-year of a chairman who been selected from the members of Board of Governors. And currently you see Mr. Powell, he's the chairman of the Federal Reserve in the US. Before that, one lady, the Janet Yellen, she was the chairman. And before that, a quite famous Bernanke. He had an 8-year tenure. He was running the Fed Reserve during the financial crisis time, and also credited to some extent who has made number of decisions that contributed to bring stability to the US and the global financial market. Before Bernanke, there was another famous governor, Mr. Alan Greenspan. He was also very well respected, but towards the latter part of his term, he was also being blamed for maintaining very loose monetary policy, and there's argument. You probably remember that we were talking in our financial crisis lecture, whether there's the Federal Reserve's low interest rates and loose monetary policy was to blame for the financial crisis, subprime mortgage market crisis. So there was the argument for and against, but what you are simply saying is these are the people who sat in the governor's chairman's position in the Board of Governors in the case of Fed Reserve in recent times. Okay, so what are the duties they perform? Right, so they have the votes in terms of conducting open market operations. Open market operations by the central bank is to facilitate market conditions, financial market condition, in the form of injection, absorption of liquidity. Injection means you are providing liquidity. Absorption means you are withdrawing liquidity, right? So they do open market operations. So all the central banks, they buy, sell government securities. Okay, so when they buy, what happens is liquidity gets injected to the market. That means if in the case of Sri Lanka, if they buy treasury bills from the market or treasury bonds from the market, the rupees get injected to the market. So rupee comes to the market, bills goes to the central bank's portfolio. When they sell, it's opposite. So they sell the security from the central bank's holdings, and the buyers, the market participants, has to pay for it. So they have to pay, and the rupee goes into the central bank. That means liquidity reduces. When they buy, liquidity increases. When they sell, liquidity decreases. And similarly, they do so-called sterilization measures. Sterilization, that means the foreign exchange related operations. When the foreign exchange being sold by the central bank in the market, market participants has to pay domestic currency to buy foreign exchange from the central bank. So when the central bank sells, means money, domestic money available in the economy goes back to the central bank. So liquidity reduces. So to offset this, okay, to sterilize this liquidity absorption to the central bank through forex market, foreign exchange market operation, what the open market operations does is they come to the market and buy government securities from the market. So then the rupees which went inside the central bank because they were selling out the foreign exchange in the first place, now being offset by central bank buying government securities from the market and paying rupees to the market. So the open market operations. So the open market operations, this is very simple way of explaining open market operation. There are other ways through which the complex operations that they carry out in terms of defining interest rates, determining where the interest rate should more or less set and guide the other interest rates in the market is somewhat complex, but that is also part of the open market operations most of the central bank carry out. So this board of governors, they vote the conduct of so-called open market operations. Any questions? Right. So you see this open market operations as one aspect. Then the reserve requirement. I mentioned the reserves. You know what reserves are now? Okay. So what you have to keep with the central bank from your deposits. So what's this percentage reserve requirement? That's also a decision by the board of governors, and there's no difference in terms of monetary board of the Central Bank of Sri Lanka too. They also make these decisions, right? So when it comes to reserve requirements, sometimes these reserves could be remunerated, but often they were not remunerated. What you mean by remuneration here is when you keep 2% with the central bank do not pay interest for those reserves. But at times they can decide to remunerate, to pay some interest for that 2% that you are keeping with the central bank. So remunerated or non-remunerated reserve arrangements also part of this decision process of the central bank's board of governors or monetary board for that matter, apart from deciding what should be the reserve percentage. Then control the discount rate in the case of Fed Reserve, US, the single rate discount rate through review and determination process. So if they set the discount rate as 10 basis points, 1/10 of a percentage point, as what you are simply seeing in today's context, or they basically set reserve rates to be 25 basis points. That means 1/4 percentage, 1/4 of a percentage point. So they review whether the market interest rates are aligning in that level, or market interest rates either remain high or either remain low. But then they do a review and determination process to bring this discount rate to the ideal levels that they are envisaging through open market operations. They also do buy sell. Through that, they drive the interest rates to come down by increasing the liquidity in the market, or makes the interest rates to increase by decreasing the liquidity in the market. So they do all that. Then they set so-called margin requirements. Margin requirements is not that popular in countries like Sri Lanka, simply because our financial markets are not that complex. So this comes with margins and all comes with derivative instruments, and you don't necessarily bring entire value of your, let's say, financial asset transactions when you have margin accounts and things like that. So what you basically bring is certain share of your financial transaction, but you basically sets that, okay, if it increases beyond this, you have new money accumulated in your account, because let's say stock prices have gone up. So you have now, originally you borrowed, let's say 1 million, but because of the stock prices have gone up, you have a 1.5 billion. So you have additional 500,000 worth of assets in your books. So this 500,000 assets is over and above your required liability. So you take this 500 million and invest in other assets. So when that asset prices reduces, then you have to bring in money. You have to bring in new money. When it increases, you can diversify, find new investments. So the margin. So what margins that you have to maintain? In case of Sri Lanka, you probably heard in recent times, if you are going to import certain type of things, you have to have 100% margins. That means you have to maintain 100% of the import value in a deposit account. That type of decisions we call. But in US and all, those margins are often comes with a financial complex transactions in the market, including derivative instruments. But in Sri Lanka and emerging market, frontier market economies, often these margins are related to the management of foreign exchange or the balance of payment related considerations. Okay, so what you do is, for instance, if you are bringing a motor vehicle, you have to keep 100% of deposits. So banks do not just open a LC to bring down a motor vehicle from foreign countries unless you keep 100% of that value in the accounts, right? So in normal circumstances, you don't need to keep anything. You can open LC. Only requirement is when the motor vehicles comes in, you have to then make the payment when the bank is making the transaction. But for board, the decision like this, monetary policy related, they might require you to keep. So the margins being set on that basis. For mortgages, they might ask margins to be set, right? So there are various ways of margins they looked at in emerging and frontier market economies, including Sri Lanka, as I was mentioning, right? So then the administrative decision in terms of wages being defined by this board of governors, salaries of the presidents of Federal Reserve banks and other officers who perform functions for the Federal Reserve Bank, and then also review bank's budget. That's a process. So the board of governors look into it, and monetary board also look into it in the case of Sri Lanka. So this is a process, not different to many other countries. Continuing, you see the board of governors also approves mergers and application for new activities, expansions. So you see banks, maybe a few banks wanted to merge together and create a bigger financial intermediary. That happens. The bank mergers happens all around the world. Okay, so mergers, acquisitions, that also possible, right? So these decisions, an application for new activities, they wanted to have subsidiaries, they want to have holding companies, whether those companies and their line of operations are approved and allowable is a decision this board of governors makes, and it's no different to Central Bank of Sri Lanka also. And also they define permissible activities of bank holding companies. They would say bank holding companies cannot perform, right? Cannot perform, let's say, money broking activities. They may define. They cannot perform activities that, in the eyes of board of governors, are too risky and that would compel the parent company's assets to be exposed to risky opportunities, weaponry and related businesses, and at times of global oil prices skyrocketing, right? Making forward contracts in terms of these agency activities. Maybe they may permit some of the activities, sometimes no. Depends on circumstances. And now it's sanctions related to some extent. In the case of US, they might define activities that you should not have certain business engagements with certain type of businesses registered in certain countries. This is sanctions. These are all kind of related engagements. That sanctions comes with the administration, government administration, but then the board of governors have to stamp them in the case of US. And this is an area where Sri Lanka and emerging and frontier market economies also exposes, but not to the extent of sanctions as such. Okay. And also the board of governors, they supervise the activities of foreign banks operating in the US. Foreign banks being allowed to operate in the US, and their activities and their requirements being monitored and supervised by the Federal Reserve. And it's no different to Central Bank of Sri Lanka also. They also look at how foreign banks operate and sets certain directions for their operations on a continuous basis. So these are very common across other central banks also. Then who is the chairman or the governor? Okay, so he is the figurehead, right? And he takes the central role of making and announcing the decisions in terms of the board of governors or the monetary board when it comes to Central Bank of Sri Lanka. And also he plays, in the case of US, as the advisor to the president on economic policy. He advises, and he been called often to the Senate hearings. And if you are watching television now, you probably have international channels, business channels, right? So you can watch Federal Reserve Governor is testifying at the Senate. So you can hear, and it's no different to Bank of Japan, it's no different to European Central Bank, it's no different to Bank of England. This happens. Okay, he advises the US president on economic policy, but US president also has his economic policy advisory council or advisory team. So he might take note of chairman of board of governors, Fed Reserve's advice, but ultimately they probably review in terms of their the policy proposals or the agenda in terms of the politics being looked at. So that's the way most of the countries operate. And Sri Lanka also, the governor could advise, but whether that advice been taken or not is a decision of the president of that country. And they testify in Congress, as I was mentioning, Senate committees, right? Parliamentary committees being called the governors and senior officials of all central banks in the world for different purposes. And they also speaks to the media of policy decision and other central bank related activities. And you probably see each and every FOMC decision is followed by a press conference, and it's not different to Sri Lanka also. Each and every monetary policy review is followed by a press conference where the governor and senior officials explain to the media of the rationality and why they had to make certain decisions, and they detail out. So that's there. Okay. So at the same time, the the governor or the chairman of the central bank's board of governors, right? They also represent in negotiation, represent the country in negotiation with foreign governments on economic matters. And at times, in the case of Sri Lanka, sometimes you probably see the governors might be representing in peace delegations also. That's a very rare kind of a representation, but generally they represent the country's negotiation in economic matters with other countries, and also negotiate with multilateral agencies like IMF, World Bank, Asian Development Bank, and regional setups of organizations on economic matters, right? So you see this type of engagement by these chairman or the governor, and they remain very influential in most of the time, because some experiences suggest that the governors or the chairman speaks out, the economic variables changes. Exchange rate moves, interest rates moves, right? Market expectation changes, because they come out with more insightful observations, and also the intentions in terms of where the monetary policies would be taken in the future, or some direction in terms of their future course of action. That's been tried to kind of, reflected through their negotiation and discussion with the media, and this may result in driving economic variables in any country. So it's a very common thing, but that itself makes the role of the chairman or the governor of a central bank, that his observations and comments need to be credible. He has to speak with credibility, so then only the market would take his word. And if he has lost his credibility, even if he speaks what the central banks intend to do in the coming months, that would not drive the economic variables, because he has lost credibility. So that's a very important message and outcome that you all can take from the role that the governors or the chairmen play when it comes to their interaction and communication. They have to say with facts and rationality, and also act upon it. Otherwise, how market would take their communication is a big question mark, right? So throughout the world, it's the case. When the central bank speaks, you see the variables, macroeconomic variables varies, changes, because they all try to kind of, maintain so-called credibility of their communication. Right. So this is the role that you see in the Fed Reserve, as well as in other central banks. Now we look at FOMC, Federal Open Market Committee. In the case of US, this committee is the very, very important committee in terms of influencing US interest rates, and correspondingly the value of US currency in the eyes of other currencies in the world. They meet 8 times a year. The general calendar of FOMC meetings are there in Federal Reserve website. Advancedly announce the meeting calendar of FOMC. And in the case of Central Bank of Sri Lanka also, the monetary policy review calendar is there. Central Bank of Sri Lanka also meets 8 times for monetary policy reviews. In the case of Sri Lanka, they also have advanced issuance calendar of treasury bills and treasury bonds that also been announced to the market in advance. Such communication in advance establishes the confidence in the market of the operations and also sets credibility and plan the investments and other macroeconomic decision by market participants. Right? So FOMC meets 8 times, and that meeting schedule been announced in advance, but this does not prevent FOMC to meet more often than what it is envisaged here. If the economy requires, circumstances requires, they meet often, more than 8 times as envisaged. Even the Central Bank of Sri Lanka's case, yes, monetary policy decisions could be made as the market conditions warrants, circumstances warrants. And there were circumstances that central bank has made that decisions even during this year outside its regular monetary policy review cycle that's been announced to the market. This Federal Open Market Committee comprised of 12 members, you know that. All 7 members of the Board of Governors, chairman and other Board of Governors, members of the Federal Reserve, are members of the FOMC, and then the 5 presidents of Federal Reserve banks in US, where US Federal Reserve Bank of New York is always, the president of the Federal Reserve Bank of New York is always a member of this FOMC. And then you have 4 other members, 4 other presidents. They are also members of the FOMC. And who is chairing the FOMC is nothing but the chairman of the Board of Governors or the chairman of the Federal Reserve. So it's a multiple role for the chairman of the Federal Reserve, and he chairs the Board of Governors as well as the FOMC. And their prime task is in terms of issuing directives to the trading desk. Trading desk at the Federal Reserve Bank of New York. And I was mentioning to you, the Federal Reserve Bank of New York, and New York being the financial center of the world, and the Wall Street and everything that you talk about. And the Federal Reserve Bank of New York's trading desk makes one single move that may drive trillions of dollars in either direction, in injection or absorption, and financial markets to flow funds in and out from their respective economies. And their moves not only limits to the US financial markets and activities, but across the rest of the world. The operations refine the direction of interest rates all around the world, as well as I was mentioning, the value of their currencies in line with inflows and outflows to those economies. Because when the US interest rates adjust, correspondingly the risk appetite of investments by fund managers all around the world also changes. Apart from the domestic economic related considerations. So if the domestic economic conditions do not support warrants, people might pull out foreign exchange from your economy. But at the same time, US decision itself drives these foreign exchange to flow in and flow out, depends on how the Federal Reserve, FOMC makes moves. So you see a very, very important role that they play in terms of guiding global financial markets. That's why we are kind of concentrating more on US central banks' functions and operations for you to kind of get a feel on how the central banks operate. Any questions? Right. So you see here, these meetings of the FOMC also very much of a structured nature, but this does not prevent them from making non-structured, if not ad hoc kind of presentations also been facilitated and decisions being made. That comes with unavoidable market circumstances like COVID now, subprime financial crisis at that moment of time, or any other emergency developments in the world economy. So you see the key professionals who runs the open market operations, okay, they bring in reports on foreign currency and domestic open market operations and other related macroeconomic issues to the desk for discussion. And it's no different in Sri Lanka and other countries also. They bring in where the interest rates are, where the liquidity levels are, where the exchange rates are, right? What happened to the exchange rate, what happened to the interest rates in recent months or weeks, and any reasons for the movements and pending bills, pending outstanding liabilities to be settled. All these details being brought into the market. And particularly in countries like Sri Lanka, the operations in terms of government financing, because the budget deficits also important, and high budget deficits and running high government debt portfolios would have repercussions across interest rate structures. So that matters in most of finance, the emerging and frontier market economies, particularly in Sri Lanka's case, government financing operations, the borrowing operations of government influences a lot on interest rates and through which the other market interest rates, probably the policy interest rate, still might be driven by monetary policy consideration, but other policy, other interest rates in the market could be driven by government's financing operations. Okay. Also, they discusses about economic forecast, whether it's a recession ahead. Recession means negative economic growths ahead. Future economy is not growing but declining. So what the direction that the monetary policy should make? Okay, in terms of inflation expectations, where the inflation numbers are, that's the price stability objective. Whether the inflation is picking up or whether inflation is continue to remain subdued. So that means you are very much capable of introducing loose, if not accommodative, monetary policy positions. So they bring in these to the table of discussions. And they outline different scenarios for monetary policy actions. What if interest rates being increased? What would happen to the exchange rate as a result of interest rate increase and exchange rate appreciation? Because when you see interest rate increase, funds flow into your economy because they look your interest rates now attractive than what it was. So other things being constant. I'm talking about ceteris paribus condition. If all the countries in the world started increasing interest rates, then no benefit because you immediately become to the same position. If US increases, US currency strengthen, and then what happens to US exports, what happens to US imports, and that would drive US currency again to a certain level. It's all been discussed. Different scenarios in monetary policy decisions. Okay, and also the congressional, Senate, if not parliamentary deliberations. So they engage with those. And then the public announcement. This is also widely followed all around the world. FOMC minutes, FOMC announcements, as soon as it's been reproduced in the Federal Reserve website, being reviewed by all market participants, including other central banks, because that gives some hint where the US might be thinking in terms of their next policy action, next policy move. That move is very, very important in terms of fine-tuning the direction of your own monetary policy and economic decisions. So this is a very common thing. Even in Sri Lanka, we also keep a very close eye on what the FOMC minutes, FOMC review hints out in terms of where the direction of US monetary policy, because that has implication. That has implication on our cost of borrowing from international capital market. That has implication on US currency levels. That has implication on other financial assets, including gold prices in the world. Okay, so it's very important, and these things being closely followed. Right. So then one could ask why the chairman of the board of governors really runs the show. It's always the chairman, it's always the governor. He's the one who comes and speaks, not other members. It's very rare you probably see other members of the board of governors comes to the front and speaks to the media. Yes, they all sits and discusses, but mainly the chairman, because it's one voice and to kind of keep that credibility in terms of communication. Many voices could have some difference in communication that would open up either biasness towards future direction. So you might not necessarily be, everybody is talking would not be giving a one directional signal. That's all possible. But within the parameters of what the chairman or the governor signals, others could spell out details. So that's what usually happens all around the world in terms of direct interaction with central banks. And the chairman, he acts as the spokesperson for the central bank or the Federal Reserve, and also negotiates often with the parliament and the presidents, the Congress and the president in the case of US. Okay, so the other very important role that he plays is he sets the agenda for the meeting. FOMC, Board of Governors, or Monetary Board, he sets the agenda. He can take out some priority items first and delay other things. They're very important because that makes or breaks some decisions that to be made by the central banks. And when it comes to central bank decisions, often the central bank monetary boards, board of governors make unanimous decisions. They all be in one line, but then of course, if you have some disagreement, the others try to factor that in and try to accommodate such disagreements to the extent, but still central banks could make call or make decisions on the basis of the voting. And in such circumstances, the chairman or the governor of the central bank, he speaks first and votes first. So the others gets a kind of a feeling, okay, this is what the governor is thinking, and governor rationalizes on this basis. So either they could still, with their disagreements, could amend their decisions a bit and kind of fall in line with the way they wanted to kind of carry out the monetary policy decisions at given particular moment of time. And this is why they speaks, votes. This is why FOMC minutes also important, because in the case of Fed Reserve of US, you probably see the observation of other members also being released to the media. So you can guess where the thinking in terms of the members. But in other central banks, including Central Bank of Sri Lanka, you might not come to know what being discussed by members separately or with their individual affiliations. What you come to know is the decision and how this overall decision being communicated, what factors being considered. So that's very common across other central banks also. And the chairman again supervises the professional economics and other policy advisors to to formulate and carry out monetary policy decision making in the central bank. Any questions? Right. Then, as I was mentioning, so-called central bank independence is also one of the key questions now everybody is asking, particularly at times of financial distress, financial crisis, or even the health-driven economic difficulties like COVID-19 now exposing entire globe. How independent is the central banks in terms of decision making? So when it comes to the independence that you are discussing, you require to look at instrument and goal independence. Instrument is what you have to achieve your goals. Different type of instruments: open market operation, reserve requirement. Okay, these were very common conservative policy instruments that all the central banks have. Right? So you remember that I was mentioning at the very beginning with the this chart three policy tools, where the reserve requirements, open market operation, discount rate. These were the main policy tools that the central banks use, conventional monetary policy tools. There are non-conventional monetary policy tools also. We will discuss those stuff. But these were the conventional monetary policy tools. But what matters is when you choose these tools, within this there are various type of instruments that you can use. Right? These instruments is invariably you can link up with these tools. So when you have the independence, whether to choose which instrument to be used is very key consideration for independence. If you have that independence, most of the central banks have the so-called instrument independence. But in the goal independence, who sets the goal for you to achieve? It's often the parliament. Right? So the legislation, central bank governing legislation being set by the parliament. So the parliaments at different times could change central bank's legislation. But what matters is frequently changing legislations are not good for any economy, any country. And the central bank's law also established to the extent to give more say in defining instruments and the desired actions and achieving goals to the central bank rather than the parliamentarians. They might not necessarily have so-called technical acumen to kind of define what these central bank's activities are. But this goal is also an important yardstick of independence, where the parliament also sets the goal of central banks to achieve, but then within that arrangement, how easily the parliament could manipulate those matters. But generally the central bank's goals are not that easy and not that straightforward to define in terms of most of the legislations are looked at. When it says economic stability, price stability and economic stability in the case of Sri Lanka, and financial system stability, right? So you may have lower inflation in Sri Lanka, so you are achieving price stability. But if you simply see economic stability, where the economy is not necessarily performing, people are not having employment, right? the financial system is not stable, then it's a question. Although you have the goal, but you have not necessarily achieved. So while achieving price stability, other things also being looked at, and then the goal drives central banks to use different instruments available with them to activate or energize those objectives also being looked at. And then with the independence being argued in the case of Federal Reserve or other central banks, revenue independence, whether the central bank depends on government budget to allocate funds, whether the central bank depends on government to give them the capital required to make financial market infrastructure. If you are depending on the revenue from the government, you would be not necessarily have that independence, because you would act in line with government's whims and fancies. That's why often the central banks all around the world have so-called independent revenue making opportunity in terms of setting open market operation interest rates, where if anybody borrows from the central bank, you are charging a certain interest rate. That's not with the revenue intention, but with your policy of interest rates, monetary policy decisions. At the same time, central banks manage reserves, foreign reserves, and sometimes the government reserves, through which also central bank could generate revenue. Central bank also invest, I was mentioning, buying government papers, through which they inject liquid to the market that's required, and then the interest return that they gain from those. From another perspective, central bank also have so-called seigniorage profit, the currency printing related profits. The face value of currency is printed, then put it to circulation, minus cost of the printing those currencies that you have put it to circulation, would define what's the seigniorage for that particular period of time. So often the printing cost of a currency is lower than the currency's face value. So you see there's a value, and that all sets central banks' revenue. And central banks all around the world have independent revenue generation ability. And this sets central bank to independently operate. And it's very common that end of the year, end of the financial year, if the central banks has profit, has made a lot of profit, they transfer these profits to the government, or then they send part of these profits to reserve accounts for their own operations, because they have to look after their employees, they have to look after the retirees, and also central banks have certain responsibilities in terms of the insurance funds that they have created for the financial markets, let's say federal deposit insurance schemes, FDICs that we were discussing. So they have to have some buffers in terms of the resources for a difficult time. So they look into those stuff. So independent revenue is another very important yardstick of these central banks. Then you see, when it comes to independence of a central bank is looked at, whether the central bank structure is written by the parliament, and is it subject to change at any time. If it is easy and subject to change, yes, there's a problem of independence. But if it is difficult, like you require 2/3 majority for changing central bank's legislation or certain clauses of that legislation, that makes more independent for central banks' operations. Because the governments would love to see central banks are maintaining loose monetary policy and accommodative monetary policy stance. Accommodative monetary policy stance means printing money, buying government papers, and contributing to government's expenditure. Okay, so then the people are kind of, facilitated without creating real economic activities, but they are creating monetary stocks in the country, and thereby it challenges the future inflation. So central bank would not happy in the outset to take up such actions unless the economic circumstances supports, and they do not necessarily see a risk in activating such possibilities in an economy. So it's a kind of a possibility that they are discussing in terms of Fed structure, whether it's been easily amenable and manipulated by the Congress or the Parliament for that matter. If that's the case, you see there's a problem for independence. Then you see the influence, presidential influence from Parliament in terms of appointing members to the Board of Governors, appointing members to the monetary board, and appointing governors or the chairmans. Okay, although terms are not concurrent in the sense president may start his tenure from this financial year, but governor might be continuing from previous financial year, where president is not necessarily the appointee of that governor, but previous president would be the appointee of that governor. That's all possible. But whether these decisions are defined by a much more structured, formal committee setup or an individual would define to some extent how independent these agencies are in the world. All around the world, these central banks are looked at these from a perspective that they have a much more clarity in terms of these appointments, and then you can define whether they are independent or not. So they look at this also as a one yardstick to measure the independence. So you see instrument and goal, revenue, structure and legislation, how those been formulated, and influence in appointments as a very important yardstick apart from tenure. I was mentioning 14 years, 16 years, that type of a term of a member of a governance board are main kind of drivers of defining independence in any central banks. And then the independence itself, there are arguments, should the Fed be independent? Federal Reserve be independent? US central bank should be independent? That's the kind of a question. People argue for independence, say, there are arguments for and against. And when you say people arguing for independence, they would say the strongest argument for an independent central bank rests on the view that subjecting the central bank to more political pressures would impart an inflationary bias to monetary policy. Please try to understand here, the argument for independence argues that subjecting central banks to political pressures would impart or drive an inflationary bias to monetary policy operations. So that means what it simply tries to say is you leave central banks to be influenced by political authorities. What it indirectly contributes to the economy is inflation. Because any money central bank prints increases the money supply, and ultimately even open market operations related central bank actions would drive prices to increase, and thereby any gain that you see would be temporary, because you might see today the apple is 100 rupees, but tomorrow the same apple would be 110 rupees. So the extra 10 rupees that you printed and circulated has not yielded any real benefit, because still you have one apple, same apple, but now you need to pay 10 rupees more. It is very simple example I just brought in. It is not that simple as what you can explain, but it's very complex. But what you are simply seeing is your real income would not be increasing if inflation is increasing at a faster pace. Your real income would decrease if inflation is increasing at a faster pace. This is like real interest rate versus nominal interest rates. Okay, so when the nominal interest rate is 8%, you know if the inflation is 3%, your real return, real interest rate is 5%. Nominal is 8 minus 3, 5 is real interest rate. But inflation has increased to 6%. When the nominal interest rate is still 8, your real interest rate is 2%. 5 has come down to 2. So it's like that. It could be negative even. So if you let central bank independence being subject to political influence, what the politicians would love is to have more money, lower interest rate. They don't want to see inflation. They don't like inflation, but they don't know how inflation happens in the economy. Yes, supply side constraints are there. Let's say huge supply shock, agricultural products being damaged, or heavy floods being taken out all the crops in terms of food related items, then the prices increases. Those are supply shocks that you can't, and even central bank can't stop, because that's supply circumstances, and whether central bank is there, you can't stop a flood. Okay, so that's a different call. But demand driven inflation, where you create additional demand by placing money in the hands of general public, by money supply increases. So the people who do not demand now has money, they can demand. So when the demand increases, the prices increases. Unless the productivity increases and the supply increases by more production, just because demand increases through more money in the economy would drive prices and eat out the real benefit that the economy has. So the case for independence very much supports the fact that you should not subject central banks to political pressure, and you should let central banks to operate with its objectives in their mind, and based on the overall economic considerations. The case against independence, people don't like central bank having independence, argue. Proponents of the Fed under the control of the president or a Congress argue. People who wants the Federal Reserve subject to the president's influence in the case of US, or the Congress, US Parliament, you can argue. They say that it is undemocratic. They bring in so-called democracy principle, majority's will, right? Undemocratic how monetary policy controlled by an allied group that is responsible to no one. They simply say the Congress and the president are elected by people, right? But the monetary policy is controlled by a handful of elite people. They are not responsible to anybody. I don't think it's right, because even in the case of the central bank's board of governors and the senior management is answerable to number of committees, number of parliamentary oversight arrangements, and general public, and they been audited by state audit agencies, being monitored by the markets, and if they do not act professionally, so-called communication example I was mentioning, their credibility gone. Even if they communicate, market would not respond. So it is not that they are not responsible, and also they have to act upon the set arrangements. They can't do any wrong or mistakes. If that's the case, if they do wrong, yes, they punish. Mistakes, then they would look at it, and then of course whether that mistakes been willfully or it's a pure mistakes, that's all been looked at. So there are cross check and balances in all the economies. But interestingly, the argument against central bank independence is coming from so-called democratic argument. So they need to be under the hammer of president or parliament, and they should fulfill the president's or parliament's will. And central banks all around the world, they are mindful of these things and they accommodate as much as possible, but still they are mindful that they have to act within the laws under which that they have to perform, and also to the extent that the long-term macroeconomic improvement and sustainability that works in their mind when they act upon things. So the argument for and against independence is now very clear. So first is case for independence, that argues very clearly you are subjecting central banks to political pressure would impart inflationary bias. Argument against central bank independence is it is undemocratic to leave out monetary policy with a handful of people instead of president or the parliament, because they are democratically elected. But sometimes so-called democratic elections, sometimes you probably see, even in the case of US, it's not majority's will. Popular vote would be against a president, but then they have electoral college. In US case is different. And you probably go and see those details of some recent elections in US, presidential elections. The popular vote is won by the person who lost the election. But who became president is, he had lower popular vote, but had more electoral colleagues, simply because the setup is such in US where you need to win states, right? So majority of states, effectively majority of members of states, electoral colleagues in their language. So then of course there are a lot of arguments. Sometimes in the case of first past the post arrangement, you may be the winner. You might have got 35% of the majority of vote, but against you, all the others have about 65%. So that's the majority in that case. But these were kind of, so-called democratic, undemocratic arguments. But where are the independence and against independence being discussed, what you have to remember is these principles. And that's what I just wanted to bring into your head with all these explanation and reasoning. Okay. So the case for independence is further elaborated here. Okay, as you already know, political pressure would impart an inflationary bias to monetary policy. Not only that, political business cycle. Economic business cycle, you all know now. Political business cycle also no different to that, but the timelines are election cycles. After the election, you see the politicians wanted to see certain type of activities being carried out, but closer to election, they, irrespective of economic condition or the economic circumstances, wanted always the monetary policy or fiscal policy that comes under their purview. To some extent, they would be able to influence, but monetary policy also they would be influencing to increase money supply, reduce interest rates. They don't care about what would happen after the election. The point in time they're probably looking at is the political business cycle. They would be mindful of re-election than the economy's priorities. So the case for independence would argue political business cycle prioritizing would have repairable impacts to the macroeconomy over the medium term. That has happened to many countries. They are still reeling from such a challenging budgetary circumstances in the past. Okay, then of course the case for independence also argue so-called accommodation. You facilitate budget deficits by buying government papers, treasury financing of large budget deficits. The government wanted their deficits being financed, and if the market does not have resources, they push central bank to buy government papers by printing money. In the immediate sense would not have much of an impact, but the money that goes into circulation would have impacts on future inflation. So the other element is the politicians have so-called principal agent problem. Who is the principal of politicians? The general public. Politicians are agents. You know the principal agent problems, owners versus employees that we were discussing, executives. So executives want to maximize their benefit irrespective of whether the investors or the business remain resilient and continue for long. So they might quickly say the machine's been run excessively irrespective of its lifetime and damage next day and run away. They want an immediate order being honored. So it's no different to politicians. Politicians would look at their temporary gain irrespective of more long sustainable path of prosperity for the economy. So it is too importantly to politicians. So the principal agent problem is worse for politicians. So this is another way of looking at so-called independence. And then the argument against independence, as we were discussed already, undemocratic, unaccountable. Undemocratic, I explained. Unaccountable, also I explained to say that central banks are not accountable to anybody. This is what they say. But in reality, even the central bank legislations that you look at, that ask central bank to be accountable on many fronts. There are a number of check and balances. Parliamentary oversight, presidential oversights, public oversight, auditing oversights, credibility oversights, the goodwill oversights. There are a number of accountability related considerations when it comes to central banks in today's context. And the difficulty to coordinate fiscal and monetary policy. The fiscal policy, budgetary and tax expenditure and revenue related policies, and monetary policy in terms of stabilizing prices and driving productive resource augmentation in economies, right? So they argue it's difficult to coordinate fiscal. Yes, sometimes it's conflicting. Fiscal policy want more and more money being printed. Monetary policy may not support. Fiscal policy may do not want interest rates being increased. Monetary policy may want interest rate being not reduced but increased, simply because they wanted to see future inflation being controlled. Fiscal policy may not like it because that increases the cost of financing. So it's very difficult to bring the balance. And then there's another argument. Although we have given independence to the central banks, they have not used its independence successfully. There may be circumstances, yes, the countries who had independence in terms of central bank's operation may not have performed well. The inflation has not been brought under control. They might have hyperinflation. So why independence for central banks? That's the argument. So we will stop at this point, and we will be continuing the central bank's behavior at next lecture. And also we would be starting another very important lesson. We are heading towards the business end of this program now. So that's the money supply process, and that would give a lot of insights into operations. And before I stopped, any questions? And Sri Lanka, nobody else has the authority to print money other than the central bank. And in many of the other countries also, it's the same. So if you don't have any further question, I'll stop at this point, and we will continue our discussions in the next class. Stay safe.